Good morning or afternoon, depending on where you're at. My name is Kim Lockridge. I'm from Engineer Tax Services. I've got Gabriel Florentino with me as well today. And we've got a number of you on here. We're going to be starting the broadcast. This will be recorded, and it looks like everybody is muted. But if you guys have, if you want to send me a chat, you can certainly do that. I'm going to go ahead and share my screen. So you have the slides. We're also transcripting this presentation. I haven't seen David or Tarek on yet, but I wanted to thank them for allowing us to present to you all today. And I appreciate the opportunity to educate you a little bit about the research and development tax credits. There's a few changes that have come along with this, and we want to make sure that everybody's up to speed. So if you can't hear me, or if you have a question or something like that, feel free to chat, do a Q&A, or simply raise your hand and I can potentially unmute you, because this is a smaller group today. We've got 10 or 12 of you, so want to make sure that this is kind of an intimate group where we can answer the questions that you guys have. The only thing that I ask is maybe just wait until we get through the majority of the slides. We do have a question and answer session at the end. I think a lot of the slides might answer some of the questions that you have, and so we can proceed with the presentation. So with that, and Gabriel, if you can help me kind of monitor the chat and the Q&A as well, because I've got multiple screens up, but I'm not going to be able to see all of that. So without further ado, I'll do a quick introduction. My name is Kim Lockridge. I'm the Executive Vice President of Engineer Tax Services. I've been with the company for about 15 years, and I am on the tax committee and the sustainability committee for the Real Estate Roundtable in Washington, D.C. That group actually, the members of that group owned 72% of all the country's real estate. So it's a very powerful group, and we have a lot of decision-making power there. With that lobbyist group. Multiple board positions. I've been investing in real estate since the late 90s, and entrepreneur, business owner, and 35 years in finance and accounting. Also a national, multinational speaker. With that, ETS, we are a specialty tax firm. We've been in the business since 2001, so we're in our 23rd year. And, we are very, very involved. We're on the R&D Coalition on Capitol Hill, the 179D Coalition. We do several different types of things. We're a specialty tax firm, so we focus on cost segregation studies for real estate. We do research and development tax credits for companies that are actively involved in research and development activity, which is what we're going to be talking about today. And we also do energy certifications, like the 179D and the 45L certifications for tax deductions and tax credits for new construction properties. So we do quite a few things, and it's we don't take the place of a CPA. We work very closely in conjunction with the CPAs, and so we want to make sure that that we've got those questions answered for them. I need to make sure that we're launching. Give me 1 second. I've got to launch some of these poll questions, because in order for you to be eligible for the CPE on this, we've got to do some poll questions, and I'm trying to find those. This is the first time I'm using this platform, so I appreciate your patience. So hopefully we'll be able to get this going and start the presentation. Okay. So let's see here. I'm trying to do both things on the different screens. So let me give you a quick background on the research and development tax credits. Okay, so the R&D actually has been around since 1981. And it was originally a temporary provision, but R&D tax credits are available for qualified research activity that are conducted at either the federal level or state level and multi-state level. This has been something that requires both credible testimony and contemporaneous documentation. There is a Form 6765 And R&D is actually available in 140 countries, believe it or not. So, for instance, China is a 200% research and development tax credit. And India is a 100% R&D tax credit. But, we want to make sure that we're focusing on, having the research and development here in the US for our clients. And let's see here. Okay, it looks like David joined, right?
David just joined.
Okay, good.
Yes.
Hi, David. Thanks for
Hi.
joining. We started a little bit because we were already behind, so hopefully that's okay. I don't know if you want to jump in.
No, I just wanted to say, welcome and sorry for being behind. I had a login issue, but Kim, we're really excited to have you. Hopefully you've had a chance to introduce yourself, but if not, Kim is an experienced real estate investor and industry leading provider of specialty tax services as an EVP at Engineer Tax Services, and we're just really excited to hear her speak to us about R&D tax credit. So without further ado, Kim, thank you so much, and we'll let you get back to it.
Yeah, thanks, David. Thanks, Trent, for having us today and with the team. And we did start a little bit, so we were starting on time, so we weren't delayed at all. So we will have some poll questions. We kind of went over that and just let them know that they have to. There's only 3, so you've got to answer all 3 poll questions in order to get your CPE. So just make sure, and then give them kind of a rundown if they had any questions. We have the chat or the question and answers feature that they can utilize. And we were just starting to talk about the research and development tax credit in a whole, as far as how long it's been around, where it's available and things like that. So without further ado, we'll continue on. Again, the R&D tax credit was passed in as a temporary position in 1981. It didn't become permanent until actually 2016. And in that 2016, they made it permanent, and then also they allowed us to take the PATH Act at the same time. So we'll go over those in our slides and kind of share with you a little bit of what that means and where it might come into play for you and your clients. Because the startup and the AMT and those were also enhanced during that 2016 PATH Act. But it was originally passed, and it was very interesting because in 1981, it was a temporary provision. So it's been around for a very long time. There was only one lapse, I think it was between 96 and 97, where there was not eligibility, but they had continued to extend it right under these temporary provisions until 2016. So that might be kind of a trick question on the poll question. It was passed in 1981 and became active at that time. And so the 4-part test, I want to talk about this. This is really important. The 4-part test is something that is mandatory, right, for the research and development tax credit. And the first stage of a research and development tax credit, I want you to think about for a second. I want to try and create a visual. You want to start the research and development activity starts with like the napkin stage, the idea concept, the light bulb moment, right? You have an idea for something, and it goes all the way through to consumer production. Okay, so it starts at the idea concept and ends at consumer production. Once that product or that process goes into consumer production, R&D activity stops, okay? Unless and until you have adaptation to that existing product and it goes back all over to the beginning again. Let's say you make the iPhone, right? So you have the iPhone, and then you have these bright ideas to make it different every year. And guess what? It's still an iPhone, but now you have the iPhone 26 or 2040, or maybe the versions there are out there now. And so you adapt that product for multiple things like function, performance, reliability, and quality. Those are the things. And then R&D process starts all over again, right? So even though you launch a product and you have that idea of the product and then it takes to fruition, all of the adaptation also is included in R&D. But you can't include that unless you go back through this 4-part test again, okay? So starting with that activity and the 4-part test, we have to, this permitted purpose has to be documented. Remember when I said in the beginning that you have to have that contemporaneous documentation. The permitted purpose has to be documented. When you file a Form 6765, it's not asking you for the permitted purpose, okay? So the IRS, though, if you file with a Form 6765, they may come back and say, hey, now we want to see this 4-part test documented. Do you have your final report? Many CPAs will do a small version of an R&D tax credit or study, and they'll just do the calculations, put it on a 6765, but there are some new regulations that absolutely has to have that backup documentation. So that's where a study comes in. You need to have that executive summary put together with all of the permitted purpose, the technological in nature, those 4-part tests, a risk of loss. There's all kinds of things that have to go into this. Otherwise, they're just going to deny the credit. Okay. So the credits are, you just have to do it right. You got to have the Form 6765, which is the federal form that you use to file the R&D tax credit. And then also you need to have the, the state forms as well. Okay. So you have to have the documentation. Now, the permitted purpose, again, is the effort to develop or a new or improved business component specifically for function, performance, reliability, and quality. Okay, so it could be a new product, it could be improved product, right? So that's that improved part over here that you want to see. That's the adaptation. Think of a app developer. Okay, so you have computer science and they develop an app, and then how many times do you wake up in the morning and have all the updates for the app, right? Because they're improving it. They're usually improving it because there was a glitch, or because they want to enhance the performance or the reliability. Maybe it wasn't stable and the app would crash, and so they had to put in some safeguards in there for the reliability or just the quality of the product. So software engineers are great if they're developing that product. They would be, perfect fit for research and development. And we'll get into some of the other industries that might be a good fit for that, right? So that's the permitted purpose. The second test is technological in nature. So it has to be technological in nature. And this is where a lot of people get lost. You have to prove that the activity performed that it has to fundamentally rely on principles of hard sciences. So physical or biological sciences, engineering, computer science, again, going back to the software developers. Engineering could be an architectural firm where they're designing and building a building. Physical or biological science, right? We have some R&D companies are out there hitting the chiropractors and the dentists really, really hard for research and development tax credits. Most of the dentists will not qualify for R&D because they don't have this hard science basis in it, okay? If the dentist has a lab, though, and they're actually making their own prosthetics and they're making their own bridges and their crowns and those kinds of things, that is a trial and error. And that would work because we actually are required to provide documentation for the process of experimentation, which is step 3. So you have to prove that there was some trial and error. Step 3 tells us, or test 3 rather, tells us that you must engage in an evaluative process capable of identifying and evaluating more than one alternative to achieve a result. So if a patient comes in and they have a crown, they need to make it. We think that this is going to work. We've got the molds, but it may not stick. It may not, have the right fit, and we may have to have an alternative result to that. There has to be some sort of modeling or simulation or systematic trial or error methodology to it, and that's how it qualifies. So not everything is going to qualify for R&D. Giving you an example on an architectural firm, for instance, right? An architectural firm doesn't usually build cookie cutter buildings, right? Everyone is unique, and the client comes in and says, hey, I want you to build me I want you to design me a building that sits inside the mountain and, is part of that. And there's a lot of research and development that has to go into the structural, maintenance of that building. What's going to work? What's not going to work? How are we going to do this? We have to test the rock. There's all kinds of things. We think we can be successful with this, but we may not be. And if we don't, we want a plan B, right? That's your evaluative process. You can't know for a fact that it's going to work the first time. You have to have a process of experimentation in order for it to qualify for research and development, okay? The fourth is the elimination of uncertainty. It must be intended to discover information to eliminate the uncertainty concerning the capability, method, or design for developing or improving the product or the process. So the IRS doesn't want to see that a chemical engineer ended up designing a train car for the federal government to transport nuclear weapons, because that chemical engineer doesn't really understand design, right, of a train car. So that would be like an architectural firm or something. So that would be a little bit different than, something. You have to prove that you could be successful. So that elimination of uncertainty is that code section 174. It's very, very important that we have that discovery and the elimination of uncertainty. So again, we have to just make sure that you could be successful in this, that you have the know-how, the knowledge, the ability. You weren't just, some guy off the street and now you want to design an iPhone, without any expertise. We have to develop that, and we have to prove that you had that education. Okay. So hopefully this 4-part test is helpful. I'm going to launch a poll question because we need to get through those. So I'm going to launch the first one here. Let's see. So if you can answer this one, it might be a little bit of a trick question. So the question is, when was the R&D tax credit first enacted? So when did it first come about? And there's a couple of dates: 1965, 1981, 2016, or 2000. So if you can answer the poll question, we'll need to get everybody on here in order to be qualified for the. Can you guys see it?
Yes, it came out on our end.
Okay, good. All right. So if you can vote on that, and then we'll move on. Okay, I'm going to give you about 5 more seconds. Okay, so, all right, 82% of you got it correct. Okay, so 1981 is the correct answer on that. So I appreciate that. Let me get this in here. Okay.
I also think we have a point. Okay, I'm sorry.
No, go ahead.
Someone had their hand raised. Neil.
Okay, great. Let's see. Okay, great. He just put it in the chat. 1981 is the correct answer. Thanks, Keith. Okay, so we're going to go back and then we'll launch another poll question here in a minute. So back to the 4-part test. Hopefully that helps bring some clarity on kind of how and what would qualify on the research and development tax credit. There are some things that are excluded from the research and development tax credits. Okay, so it cannot be funded research. So I did actually have a client who developed and designed a train car for the federal government to transport nuclear weapons. Believe it or not, that was one of our clients that we worked on. Now, highly confidential, obviously, with the design and everything they did for obvious reasons, but it was funded to the tune of $5 million. They were given $5 million in funded research to develop this train car, and it took them years to do. Ultimately, they ended up spending $8 million for this train car. And so 5 million of it was exempt from the R&D tax credit, but they were able to claim 3 million of those expenditures in that design. So that was very helpful. And we'll get into kind of what what qualifies, right? What expenditures are qualified for. Then there's also another part of this where you have to retain the rights to the knowledge or the technology. You have to own the rights. So if you hire a third-party computer engineer to develop an app for you and they actually own the rights to the app, that will not count towards research and development tax credit. You have to own the rights to it. Otherwise, that developer is going to get the research and development tax credits on that activity. Okay. Also, it has to be performed in the U.S. So any of these activities have to be performed on U.S. soil in order to be qualified for the U.S. federal R&D tax credit. Okay, so it has to be on U.S. soil. If you have a client, if you have an employee that actually flies to China or somewhere else overseas, you actually have to deduct the time that they spent overseas from the qualification, right? It has to be part of the calculation and documented. So that's always part of our questions as well. And then varying industries. So it could be so many different things: software, pharmaceutical, chemical companies, food processors. We have a lot of food science. I have an ice cream manufacturer. I have a flavor company that all they do is manufacture organic flavors for ice cream, right? So I had both of those clients, actually made the introduction. So the flavor company was able to be introduced to the ice cream company, and they were able to start working together, which was very interesting. Construction, architectural design, those are the varying industries that could, and we have another slide that will explain this a little bit more in detail. But those are some of the exclusions. Okay, so turning to the 2016 PATH Act. This is the PATH Act that actually made the R&D tax credit permanent. So now it's not a temporary tax credit anymore; it's actually permanent. And also, what happened was, Congress and leaders of our country were going and asking the IRS, why is the R&D tax credit the most underutilized tax credit in the market? Why? Why are people not exercising their right to the research and development tax credit? And the answers were very surprising. And that's because a lot of startup companies have R&D. A lot of startup companies do research and development in their startup phase, right? They might be pre-revenue, or they might be in the red, right? Maybe they just have investors that help them. And so they don't really need a tax credit because they're not making any money. And so they weren't applying for the R&D tax credit. It was just a waste of time and money for them. So they just didn't chase after it. Well, when Congress actually got hold of that, they in this PATH Act bill, they said, well, we want those startup companies to be a part of this R&D, and we want them to file for this R&D tax credit. We want to incentivize innovation in our country. And so the PATH Act actually gave us a couple of different things. That was one reason, was the startups, and the other one was the AMT. If you fell under the AMT, which a lot of successful companies do, you couldn't even utilize the R&D tax credit. So that was ridiculous. So it's like you get a tax credit, but you can't use it, right? So it just sits there into perpetuity. So what happened in the PATH Act is they actually gave us the ability for the AMT turnoff. So as long as you have 50 million in gross receipts in the last 3 years average, and you're a privately held company, you're not limited to taking the R&D tax credit against the AMT anymore. So you can take it even though you're under AMT, which is really nice. That's the alternative minimum tax. Okay, so for those of you that are not aware. So that was very interesting that they gave us that AMT turnoff in the 2016 PATH Act. The other part of it was for startups. So there's a FICA offset. What this means is that if they are truly a startup company, okay, which means, and they give us the definitions, if you have under $5 million in gross receipts, and that's from the date of start, right? And that could be gross receipts, even could be something like interest from a bank account, right? So if you have that, that's considered income. And so therefore you can't have any income for more than 5 years, has to be under 5 million in gross revenue. And if you do meet that criteria and you qualify for the research and development tax credit, you can't use the credit because you're, probably in a place where you're not, eligible to utilize it. And so what they do is they allow you to take the R&D tax credit after it's been filed on your return, and you can offset the FICA tax that you paid for payroll. And that's capped at $250,000. Okay. And you can do that for up to 5 years. So startup companies can now actually utilize the research and development tax credits that were before they couldn't. Okay. So now they can do the payroll offset, and that all came in the PATH Act. Okay, so I'm going to launch another poll question because we have 3 to get through. So let me get back over to my screen there. Okay, so I'm going to launch another poll question. Okay, this one is, how many parts are there to test for research and development? Okay, so 2, 3, 4, or 5. How many parts are there to test for the R&D tax credit? So if you can answer that, just reminder, we need to have all 3 polls answered in order for you to be eligible for CPE credit. So if you can make sure and answer those. And see, it looks like we have everyone, so thank you. So we have 92%. Good job, guys. And the answer is 4. There's a 4-part test in order to be eligible for the R&D tax credit. So, okay, so moving on, what is included in the calculation for research and development tax credits? Okay, so the first thing is qualified box 1 W-2 wages. Okay, so there's 3 different levels of this. There's, let's say, your main project manager. That would be the main level, probably the most wages that you can utilize in there. The wages of the time of that person specifically dedicated to research and development. You can't take the entire wage unless 80% or more of that person's time was involved in qualified research and development activity. So that has to be documented. You've got to prove like how many hours this person worked, what are his activities, what did he do? And that has to be in that contemporaneous documentation as a requirement to take the R&D tax credit. So there's that. Is the main project manager. Then one person above them, one level above, a supervisor who oversees that project manager. These are usually shareholders or an owner. Part of their time oversees that person to say, hey, what are results? What are we seeing here, right? And then that's the second level. The third level is actually a support role. So somebody that might be assisting the project manager. Now you might have multiple project managers, right? So it's not just one person, but what it is that person, their supervisor, and then their support role. Okay, so we can have multiple levels of those wages. Now, this is typically a wage-driven credit. So this is a credit that is based on W-2 wages, but there are other ways to develop the criteria. The second, besides wages, the second qualifying factor are subcontractors. If you pay a subcontractor to develop an app for you and you're paying them on a 1099, as long as you own the rights to it, you actually can take that payments to that subcontractor as contributors to the research and development calculation. Okay. And the third part is supplies. These are supplies that are used, consumed, and or destroyed during the R&D process. So for an architectural firm, let's say they do a 3D model of the building, right? And they present it to the client. The client's like, oh, let's make all these changes. Let's do this and this and this. They throw that prototype away or that model away. The cost of that would be a supply that's used, consumed, and or destroyed during the R&D process, okay? Another example of subcontractors would be somebody you hire if you are an architectural firm and you hire a HVAC engineer to kind of help you with maybe the HVAC system, right? You're bringing them in as long as you still own the rights to it. You're stamping the blueprints are involved. It has your name on it. You own the rights to them, copyrighted. So things like that. Those are examples of that. Now I do get questions. Hey, we got a patent for this particular, does the cost of the patent, which was very expensive, is that involved in the R&D process? And I go back to this slide. Is it a wage? No. Is it a subcontractor? No. Is it a supply? No. So the cost of the patent itself is not going to be included in the calculation for the R&D tax credit, but the wages of the person who wrote all the applications and all of the submissions and those types of things back and forth, those wages do qualify. So indirectly, the patents qualify, but not directly. Hopefully that helps give you some examples of what qualifies and what doesn't, okay? And now, we have contemporaneous documentation. This is the stuff that's actually required. So I know that there's a lot of people or CPAs that are out there just doing the Form 67, 65. The calculation for the R&D tax credit is actually the easiest part. The hardest part is that contemporaneous documentation. You have to have the backup. You have to identify all the business components, the patents, the patent applications, the annual R&D and technological plans, research projects, authorization requests, internal and external, and the list goes on and on. Modification reports, error logs, technical reports, laboratory notebooks. These prove that scientific part of it. If you can't prove that hard science, they won't allow you to take the R&D tax credit. You can take it, but they might deny it. Okay, so you've got to make sure that you have that contemporaneous documentation, which is important for the actual executive summary at the end, not just the 6765. That's the easy part. Anyone can file a 6765 in the tax return. But that final executive summary to document where those numbers came from is the most important part of it. Okay. So who else is a good fit for research and development? Here's a couple of industries that I've highlighted. The ones in orange are just no-brainers. Okay, so architects, engineers, design build firms, food sciences, life sciences, manufacturers, software developers. Like everyone on this list is a really good fit, but those are the ones that we work with the most. We do have a ton of breweries, wineries, and distilleries, which are always really fun. You know, you have wineries that are always testing, you know, whether it's the, you know, the bottling or the process or the process of processing the grapes, you know, the distilleries, the aging process. I mean, all this is food science, right? And so we have a lot of tool and die companies and plastic and injection molding, all that kind of stuff. So these are a really good list of who would be a good fit. So if you have any of those clients, or if you work with anybody that is in these, you know, this is a great way to help them with some tax credits. So here's some numbers. I want to just give you the R&D tax credit is a calculation based on the activities from the prior 3 years. So you have to do a 3-year average of the last 3 years of research and development tax credits. And what's interesting to note is that the IRS requires that 3-year average, it has to have an increase each year. So you want to see an increase in R&D activity every year. So if you have, and I have a case study or an example of where it didn't happen, and it shows you what it did to the credit. But it basically incentivizes increased investment in R&D, so that increase. Our tax credit, I know I talked about China and India having 200 and 100% respectively of tax credits. Ours is about 14%, but you also have to deduct out some of the expenses, which is a little ridiculous. So it works out on paper to be, after the expenses, about 6.5%, which is very, very low, but it's still better than nothing, okay? And also over 40 states have additional R&D tax credits outside of the federal tax credit, okay? So just make sure that when we do the studies, we want to make sure, like, we have a lot of clients that have multiple architectural firms that have, you know, multiple offices in 4 or 5 different states, right? So that's always very, very helpful, and we do state and federal tax credits for them. This is a case study. This one shows, and these are a little bit older numbers, but this is an architectural firm in New York. The total wages, you can see, were very similar between 19 and 20. The qualified R&D wage is very similar. The ratio to the qualified, these are what we came up with, the qualified R&D wages, not all their, you know, obviously it wasn't every single wage. So there was a lot of them there that included it. They worked out to be, the federal tax credit was about $55,000 the first year, $50,000 the second year. And this is what I was saying before, the 3-year average. You can see that in 2021, their wages dramatically dropped, right, by $200,000. And therefore, their activity also dropped because it was really only 50%, whereas before it was more like 30 or more 40%. And so therefore it dropped. And so what happened is their tax credit, look what happened. They went from $55,000 a year to $50,000 a year to $7,400. And that's as a direct result to that 3-year average. That new year drove the rest of the years down. Okay, so that's giving you an example of what that looks like. Okay, so there was a new law that came out in the Tax Cuts and Jobs Act, which was in 2022. Well, actually, that was in 2017. Okay, so the 2017 was the Tax Cuts and Jobs Act, which we were intimately involved with. However, one of the surprises in that bill was that in order for them to get the R&D tax credit passed in 2017 and some of these enhancements, they would have to amortize the expenses starting in 2022. Now, this was ignored by so many people, and we shot this from the rooftops, and we screamed and said, you know, look at what's going to happen. This is going to be a problem. And everybody thought it would just go away and they would change the law, and they didn't. And then 2022 came along, and now all of a sudden, let me go back a slide real quick and show you that this qualified R&D wages, okay? So anything that's a qualified R&D wage, these 443 numbers, this line right here, instead of, you know, normally with wages, you get to take an expense, right? It's an expense, it's a write-off. What happened is when you moved those qualified wages to the 174 expenses, and therefore ultimately the 41, that ended up triggering that number right there now has to be amortized over 5 years starting in 2022. So it doesn't change the credit because you're still using the same numbers. The credits are the same. They don't change. But the problem is you now don't get a $443,000 tax deduction. You get less than $100,000 each year for 5 years. Okay, that's a huge problem, and only because it qualified for the research and development tax credit. So we actually are, I remember telling you at the beginning of this that we are on the R&D coalition. This has been something that we have worked very, very closely with a lot of, you know, like the president of the AIA for the architectural, you know, community on Capitol Hill to overturn this and to go back to immediate expensing for the R&D tax credit. It was in the bill, which was the American Families and Workers Act that was voted on earlier this year. It passed the House, but then it got to the Senate and did not pass. And that's only because it was coupled with the child tax credit, which is very controversial. So the R&D tax credit, the amortization going away is a bipartisan bill, right? We don't have one side or the other. It doesn't matter who the president is going to be. They want that to go back to immediate expensing. They realize that we're losing jobs to overseas because of this. And so companies are, you know, are really, really hurting because of this amortization rule. So we believe that it will be overturned. We know it will be overturned. It's just a matter of time. We do have a lot of support. We started on this back in 2018-19, I believe, and we had a congressman who authored the bill for us, and then she was killed in a car accident, so we had to start all over again. But we will get this overturned, and it will go back to immediate expensing. It's just right now there is a little bit of a caveat. Okay, so I just want to make sure and bring that to your attention because the amortization is kind of big news. It's a big deal, and it's quite damaging to some companies if they've been used to taking those expenses for the wages and now they have to amortize them over 5 years. That's painful because they're going to end up paying more money even though they get the tax credit. Okay. So what has happened as a result of the amortization, I don't know how many of you guys understand the expense categories, but under a 162 expense, that's research and development. In one category, it can be expense. In 174, if it moves from 162 to the 174, it has to be amortized. And so what people are doing is instead of claiming it under the 174, they keep it under the 162, which is not correct, but that way they can still take the immediate expensing, okay? But they're not qualified for the R&D tax credit. The problem with that is that if you've been filing for the 174 tax R&D, and then you all of a sudden don't have any 174 expenses, the IRS isn't stupid. They're going to look at that and say, well, you've had 174 expenses and now all of a sudden they're 162 expenses because you have this amortization, and they will come after that client. So be very, very careful when you start taking the R&D tax credit that it is legitimate. It should be in that 174 expense. And that's what we do in our position, is that we confirm the 174 expenses. Okay. So I'm going to open it up to questions. I'm going to put Gabriel's contact information on the screen. This is his direct phone number and the email address. And I want to launch one more poll question so that we can finish that up. And then we'll go to some questions so that we can clarify where we're at on this. And we can certainly open that up. So one more poll question. Have you learned something new today? So hopefully you did, but if you can submit that poll question, I would appreciate it. That's the final one. 100% said yes. Thank you so much. I'm so happy. Oh, somebody changed their mind. Okay, it's back to 92%. That's okay. Hopefully that is helpful for you guys. And I like to just open it up. Certainly you can chat, or there's a Q&A as well that you can put in there if you have questions about a specific client, a specific industry, if there's anything of interest, or if you just want clarification. I know I went through those slides pretty quick, but this is recorded. So if you want to reach out to us via email, you can certainly do that as well if you don't want to answer or ask it on the screen. Okay. Okay, so I do have a question here that is asking when the amortization might go away. That's a good question. I wish I had a crystal ball, but I would say that I'm thinking it's going to be January or February before we get this repackaged. This is actually the amortization of the R&D tax credit is also in the same bill as the bonus depreciation for cost segregation, if you guys are familiar with that, and the child tax credit. And so it did not pass because of the child tax credit, actually. So, okay. So I just wanted to let you know that that's something that's, important there. So I'm thinking that we might repackage this and get this into another bill January, February, hopefully before we have to file 24 taxes, but not 100% sure. So I do have somebody, I don't have a name, just a phone number, who mentioned that they have responded to all three, but they keep receiving bought as disabled. So how to ensure CPE. So, whoever you are, could you email Gabriel and just let us know that you were having trouble on there, that you did answer the questions, and we'll make sure that we get that CPE certificate to you. We also need your email address anyway, so that'd be great, because we will run a report of everyone here, but it's just your phone number. We don't have any kind of verification of who you are. So that's the person with the phone number, the 330. Okay, and then let me see if we have another question. Oh, will the amortization change be retroactive? In the bill that was proposed, it would be retroactive. And that's a very interesting question. I actually should put that in a slide. So thank you, Neil, for asking it. To elaborate on that is that it was written that it would be retroactive. And interestingly enough, the IRS had already told us that if it was passed, that we would be able to go back and get the rest of the what we amortized already in 22 or 23, or maybe now even in 24, that you can go back and just make a simple adjustment using a form 3115, which is it's a change of accounting method technically, but because it's an amortization and a depreciation kind of issue, you can just make that up in a 3115, and it will be refundable at the time you file the 3115. So you're going to get that money back immediately. You don't have to just move it up to the next tax year. Okay, so when you file it, it's immediate and it's refundable, which is nice. So they did tell us that if it did get overturned and it would be retroactive, that you can make it a quick adjustment. So it's always good to do if you are required to file these expenditures under the 174. You want to make sure that that you're filing it, and that if we have to go back and make that retroactive, we can. Okay, so if you've been amortizing it and now you don't have to, we can go back and get it. Okay, so thanks, Neil, for your question. I appreciate that. Any other questions? Let's see here. Okay, Elliot, you confirm. Thank you. Okay. Any other questions that I can help with? Okay, so I think we're going to go ahead and close out. please make sure you take a screenshot or a picture or write down Gabriel's contact information. He's also on this call, and if we work very, very closely together. So if you have any questions that come up, or if you have any clients you'd like to discuss, let's talk about that real quick. If you do have clients, really what we need to do an evaluation, we do a complimentary evaluation for the research and development tax credits. We'll put together a benefit analysis and a proposal. That actually we would just need to get annual payroll reports, including titles, for probably the last 4 years. I'd say 2020 through 2023, and potentially what the estimates are for 24. So it's not a lot of information, just payroll reports you can usually get from a payroll company, or you can print those out. But we do want to have the I don't need the names of who gets paid what. I really don't. I just need the titles. So I don't really care who it is. Just give me the titles and the amount they were paid that year. And then if you have a lot of subcontractors, then the subcontractors it would be nice to have a list of how much was paid to each subcontractor and what they did for you. Okay, so those are only the things that I need to put together a benefit analysis. We can evaluate it and give you an estimate of the credit, and then we can get you a proposal of how much it would be for the R&D tax credit study, and then we can help you with that to determine whether it's a good return on investment for you or not. Okay. Okay. Last chance. Anyone have any other questions? Then we'll just go ahead and end the meeting. And I appreciate your attention and thank you for your questions. Hope this was very helpful for you. Please reach out if you have any other questions. Hold on, one more. Looks like will the amortization change? Oh, okay. It just says thank you. Okay. Well, I think we're good to go. We'll go ahead and end. Thank you again for everybody and your attention. We'll talk to you soon.
For an amazing presentation.
Thanks so much, Kim. We'll be in touch.
Sounds good. Thanks again for everyone.
Bye.
Bye.
Everyone.
Well, Pam, the reason for that is many times the BAs are wrong. Like they didn't apply bonus, or they had the wrong year, or there was 0 for a 15-year property when they actually own a site. Like there's a reason.
No, I understand that, but I don't have that on Kim's.
Yeah, but
BA.
that's
Well,
going to be mostly automated though. As long as the dates are put